War rarely begins the way most people expect. In the modern world, it does not start with explosions on television screens or emergency speeches delivered at dawn. It begins quietly, through positioning, pressure, and signals that are easy to ignore until they are no longer ignorable. Right now, global markets are operating under that kind of pressure, and Venezuela sits directly inside it. Venezuela is not just another troubled economy. It holds the largest proven oil reserves on the planet, estimated at over 300 billion barrels, surpassing even Saudi Arabia in untapped potential. These reserves represent a strategic asset in the global energy landscape, where oil remains a cornerstone of industrial activity, transportation, and economic stability. Geographically, Venezuela occupies a pivotal position in the Western Hemisphere, bordering the Caribbean Sea and sharing frontiers with Brazil, Colombia, and Guyana. This location places it at the crossroads of major shipping routes and influences regional dynamics in Latin America, a region historically sensitive to external interventions. The country's role in global energy markets cannot be understated. As a founding member of OPEC, Venezuela has traditionally wielded influence over oil production quotas and pricing strategies. However, years of political instability, economic mismanagement, and international sanctions have reduced its output to a fraction of its capacity, currently around 1 million barrels per day, down from peaks of over 3 million in the late 1990s. This decline has created vulnerabilities, but it also underscores the potential for disruption. Any sudden change in Venezuela's status could ripple through global supply chains, affecting everything from refinery operations in the United States to energy security in Europe and Asia. In this context, discussions among analysts and institutions have increasingly focused on the risks associated with escalating U.S.-Venezuela tensions. Structural pressures have built over time through a series of sanctions, diplomatic isolations, and economic constraints imposed by successive U.S. administrations. These measures, aimed at addressing allegations of human rights abuses, electoral irregularities, and ties to transnational crime networks, have weakened Venezuela's internal systems while amplifying its geopolitical significance. A potential U.S. military strike, even if limited in scope, would not occur in a vacuum. It would represent an escalation from these quieter forms of pressure, potentially interpreted as a broader signal in international relations. Modern conflicts often unfold this way, not through overt declarations of war, but via incremental steps that test boundaries and reshape alliances. Sanctions, for instance, function as economic warfare, restricting access to international finance and technology. In Venezuela's case, U.S. sanctions have targeted the state-owned oil company PDVSA, limiting its ability to export crude and import necessary equipment. This has led to a humanitarian crisis domestically, with shortages of food, medicine, and fuel, while internationally, it has prompted closer ties between Venezuela and non-Western powers like Russia, China, and Iran. Strategic signaling, such as naval deployments in the Caribbean or public indictments of Venezuelan officials, further heightens the atmosphere of uncertainty without immediate kinetic action. If the United States were to engage in a strike on Venezuelan targets, the global consequences could extend far beyond the immediate region. Energy pricing would likely be the first area affected. Oil markets are inherently sensitive to perceived risks in key producing areas. A disruption in Venezuelan output, or even the threat of one, could lead to repricing in futures contracts as traders account for potential supply shortfalls. Historical modeling suggests that such events might add a risk premium of several dollars per barrel, depending on the duration and severity of the incident. This, in turn, could influence inflation expectations worldwide, as higher energy costs filter through to transportation, manufacturing, and consumer goods. Currency confidence might also come under strain. In an interconnected financial system, geopolitical instability can prompt shifts in capital flows, with investors seeking safer assets. The U.S. dollar, often viewed as a haven during crises, could strengthen temporarily, but prolonged uncertainty might erode trust in broader monetary policies. Central banks, reliant on maintaining credibility, would need to monitor these developments closely, potentially adjusting interest rates or liquidity measures to mitigate spillover effects. Market psychology plays a critical role here. Fear of escalation can amplify reactions, leading to volatility that outpaces the actual material impact. To understand these dynamics, It is useful to examine how geopolitical shocks have historically impacted commodities markets. Commodities, by their nature, serve as barometers of global stability, reflecting both supply-demand fundamentals and sentiment-driven adjustments. During the 1973 Arab-Israeli War, for example, oil prices quadrupled in response to an OPEC embargo, illustrating how political events can override economic basics. More recently, the 2022 Russian invasion of Ukraine triggered sharp increases in natural gas and wheat prices, as markets anticipated disruptions in export routes from the Black Sea region. Silver occupies a unique position in this ecosystem. Unlike gold, which is primarily seen as a monetary asset and store of value, silver functions in dual capacities, as a hedge against uncertainty and as an essential industrial input. Approximately half of global silver demand stems from industrial applications, including electronics, solar panels, medical devices, and automotive components. This duality means silver's price behavior can diverge from gold's during crises. While gold might rise steadily as a safe haven, silver could experience more pronounced volatility due to its exposure to both financial flows and real-world supply chains. Several factors contribute to silver's distinct reactivity. First, the market size for silver is relatively small compared to other commodities like oil or gold. Annual mine production hovers around 800–900 million ounces, with above-ground stocks providing a buffer but not unlimited flexibility. Liquidity in silver futures and exchange-traded products can thin out during stress periods, leading to larger price swings. Supply constraints further exacerbate this. Major producers such as Mexico, Peru, and China account for over half of global output, and any logistical disruptions, whether from labor issues, environmental regulations, or geopolitical events, can tighten availability. Institutional behavior is another key element. Large funds, pension managers, and corporations often adjust portfolios in response to risk models that incorporate geopolitical variables. If a U.S. strike on Venezuela were to occur, institutions might increase allocations to precious metals as part of diversification strategies. This hedging could drive demand for silver, particularly if industrial users preemptively stockpile to avoid future shortages. Historical precedent supports this. During the 2011 Arab Spring uprisings, silver prices surged over 80% in a matter of months, reflecting a combination of safe haven buying and concerns over Middle Eastern supply routes that indirectly affected global trade. The concept of rapid market repricing within short timeframes, such as 72 hours, merits careful consideration. Markets today operate at speeds unimaginable in previous eras, thanks to algorithmic trading, instant communication, and 24-hour exchanges. In scenarios of sudden geopolitical tension, prices can gap higher or lower as information disseminates. For instance, following the 1990 Iraqi invasion of Kuwait, oil prices doubled in under a week, driven by immediate reassessments of Middle East stability. Similarly, the 2008 financial crisis saw gold and silver experience sharp intraday moves as liquidity evaporated. In a hypothetical U.S.-Venezuela strike scenario, silver could see accelerated repricing if the event disrupts regional stability. Venezuela itself is not a major silver producer, but its proximity to key Latin American mining hubs could raise concerns about shipping lanes in the Caribbean. If naval activities intensify, insurance costs for commodity transports might rise, indirectly pressuring silver supplies from nearby countries. Modeling suggests that in extreme stress conditions, prices might overshoot fundamentals, reflecting panic rather than equilibrium. However, such moves would likely be temporary, as markets recalibrate based on actual outcomes. It is essential to note that extreme price movements, if they materialize, would signal systemic stress rather than inherent value shifts. A figure like $347 per ounce, discussed in some analytical circles as a worst-case modeling outcome, would represent an outlier scenario, perhaps involving compounded factors such as simultaneous disruptions elsewhere or a broader flight to tangibles. Historical examples, like the 1980 silver spike to nearly $50, adjusted for inflation, over $150 today, during the Hunt Brothers market corner, demonstrate how concentrated buying can distort prices. But these are exceptions, not norms. Turning to how modern financial systems respond to uncertainty, capital rotation becomes a central theme. In times of risk, investors may shift from equities and bonds toward commodities and currencies perceived as resilient. This rotation is often guided by quantitative models that simulate various scenarios, incorporating variables like probability of escalation and economic multipliers. Hedging behavior amplifies this. Derivatives markets allow institutions to protect positions without direct asset purchases. But in volatile periods, this can create feedback loops where options pricing influences spot markets. Risk management decisions at the institutional level drive much of this activity. Unlike retail speculation, which might react emotionally to headlines, institutions operate on mandates that prioritize preservation of capital. If a Venezuela-related event elevates global risk premiums, portfolio managers could increase silver exposure through ETFs or futures, contributing to upward pressure. Data from past crises, such as the 2014 Crimea annexation, shows institutional inflows into precious metals rising by 20–30% in the initial weeks, stabilizing as clarity emerges. This analysis underscores the interconnectedness of geopolitics and finance. A potential U.S. strike on Venezuela would not be isolated. It could intersect with ongoing tensions in other regions, from the Middle East to Eastern Europe, compounding effects. Energy markets, already navigating transitions to renewables, might see accelerated volatility if oil dynamics shift. Inflation expectations, currently moderated by central bank actions, could face upward revisions, influencing everything from consumer spending to government borrowing costs. In reflective summary, this examination represents a scenario analysis based on historical precedents and structural vulnerabilities, not a definitive forecast. Geopolitical risks evolve unpredictably, and outcomes depend on diplomatic efforts, international responses, and market adaptations. Understanding these systemic interconnections is essential in an increasingly fragile global environment, where quiet pressures can precede significant shifts. By maintaining awareness of such dynamics, stakeholders can better navigate uncertainties without succumbing to undue alarm.